I'm Michael Wilshire. I'm here from Bloomberg New Energy Finance. Bloomberg New Energy Finance, actually we were a startup called New Energy Finance and were acquired by Bloomberg at the end of 2009. What we do is provide information and data about what's going on in the clean energy and related markets. And this map is just showing you the locations where we have people around the world. So our analysts, for example, who are researching into these markets are in a combination of Europe. We have quite a big team in both in China and other parts of Asia. We obviously cover North America, West Coast and East Coast, and we're also looking at markets such as South America and Africa. We actually have a big team within Africa who are working on data that allows us to do all the analysis that we base our research on. Essentially, our research is about policy, it's about technology, it's about economics, and it's about finance, as well as an in-depth look at the supply chain. So we're looking at it very much in the eyes of investors or people who are looking at the industry with a financial eye. What I'm going to do is run through quite a bit of data and show you what's been going on in the markets, and then talk a little bit about some of the subsectors and what we see there. So in terms of new investment in clean energy, this is net new investment into clean energy. We're at a roughly $250 billion a year industry in terms of total investment. It was $281 billion last year in 2012. 2013 will probably be a little bit lower than that. You can see how fast it's grown. It was growing extremely fast up to 2011. But we saw something of a tail off in 2012, largely because of the policy cutback in, for example, parts of Europe with retroactive action on feed-in tariffs. And a lot of the assets that require project finance and bank finance, those have been, I wouldn't say impossible to obtain. Those markets are very much open, but harder to obtain, particularly, for example, for longer-term debt. Looking at some of the trends in terms of region, North America, you can see the trend here. This is quite a volatile trend in terms of investment. The reason for that is the policy in the US tends to be a little bit stop-go. You have something, for example, called the production tax credit, and you never quite know until it's extended whether it's going to be extended. So this creates a rush of investment and then a bit of a hiatus as people work out whether the policy measure is going to be kept in place. Europe has seen quite sharp falls in terms of investment because of, for example, in Spain, retroactive action, not just cutting back on future policy support, but retroactive action. But we're continuing to see very strong growth in Asia, in China in particular, and indeed in other parts of Asia, such as Japan, which has announced strong policy support and has a real need for energy, given what's happened to their nuclear industry. And then in other parts of the world, Central and South America, and actually the Middle East. You would think not much in the Middle East because they've got lots of oil, but there it actually makes sense in some cases to deploy solar and sell more oil rather than burning more oil to produce electricity. So we're seeing a lot of interest in those markets. This is simply looking at the quarter-by-quarter effect, and you can see the tail-off that's occurred in the last 18 months much more starkly as you look at it by quarter. And these numbers are right up to date. We've got the latest data for the third quarter of 2013. Now, where this gets quite interesting, I think, is when you break it down by sector. And we've color-coded this. So on the bottom is wind. Solar is the yellow sector. And by the way, this is net new investment. It's both investment into the supply chain as well as investment in developments. Quite a lot of this would be developments as opposed to just supply chain. And you can see just how significant solar has become as a proportion of the total. Solar is roughly 60%, probably a little bit more of total investment. And when I started doing this, which was 5 years ago, it was roughly 25 to 30% of the total. So solar has grown, and I'll explain a little bit why that's happened. It's all to do with cost competitiveness as we go through. That's one way of cutting the numbers. The other is to look at it in terms of the type of finance. And a lot of it is asset finance. A lot of it depends on bank finance and getting these large-scale projects funded. There's a relatively small but very important portion of VC and PE within this, and I'll talk about some of that in more detail in a moment, because that's obviously the seed corn for what gets built later, and has been in the past, will be in the future. The other interesting thing is just how much small distributed capacity there is, and most of this is solar. But this is essentially not large-scale solar in utility scale solar farms. It's distributed. It's on rooftops. So what's going on here is also a change, not just in the mix, but also in the nature of the network, because this is a much more distributed technology, and we're moving for a world which had lots of centralized generation on a fairly predictable basis to one where a lot of the generation, and certainly the incremental investment in generation, is more distributed. And that has implications for how you manage it, how you integrate it, and it's creating a lot of interest in areas such as the smart grid in terms of how to integrate the grid and make that more flexible. So on to VC and PE. As you look at this by subsector, that's the bottom of the chart, rather, and that's an area we see quite a lot of activity in terms of, we call it digital energy, but it's everything from home energy management to grid optimization to the ability to manage the grid more flexibly. So there's a huge range of opportunity there. You might think that solar would be a very mature sector, and in many ways it is. But nonetheless, we are seeing continued innovation in solar. We're seeing a lot of, you can see it on the chart, quite a bit of VC money still flowing into solar, both in terms of underlying solar technologies, but also downstream, its monitoring and its systems to help, for example, run the assets that are being installed more effectively. And then in, for example, biofuels, we're seeing a second-generation effect. A lot of the first-generation biofuels and bioenergy has been developed. It's been fairly capital-intensive, and not all of that is fully utilized today. But there's a search on for low-cost, economic, second-generation biofuels that you can produce from cellulosic residue, for example, the stuff that's left on the field after you've grown crops. And that's potentially a massive fuel market if you can do it economically. And we're in the process of commercialization and scaling up. I won't go through these in detail because they're just a snapshot, but just to give you a flavor of some of the recent VC and PE transactions, I'll pick a couple or two or three. Joule Unlimited is, for example, producing fuel from waste CO2. So it's algae. It's using a combination of waste CO2, sunlight, algae to produce fuels. Fluidic, a bit further down, is energy storage. They're using zinc air batteries. And Urban Green Energy, for example, is a combination of storage and distributed energy. And they also have a play in EV charging. One other thing about these is most of these examples, and they are just the last quarter, you can see the values on them. So a lot of this is growth capital. This isn't early stage. So if you're thinking about this from an early stage investor, this is demonstrating that there's quite a bit of growth capital now flowing into the sector, which is obviously funding the next stage of growth. So how have clean energy stocks performed over that period? Well, the answer is it's been pretty much a roller coaster ride. If you had the hindsight's a wonderful thing, but if you had the foresight to invest in clean energy maybe at the beginning of this chart in 2003 and sell in 2008, you would have done very well as an investor. In fact, you'd have got roughly 30% compound annual growth. We did say at the time, actually, we couldn't find any industry anywhere that had sustained 30% compound annual growth, certainly indefinitely, and not even for a very long period. So the collapse when it came in 2008 was obviously due to the financial crisis, but was a pretty sharp one. We saw a fairly rapid recovery from then. And then we've seen clean energy stocks in general. This, by the way, is an index that we've developed, and it's an index that you can track. It's a listed index. And you can see that clean energy has underperformed in the period round about 2012. But there's been something of a bounce back in the last 3 quarters. So in the last 3 quarters, we've seen a little bit of a resurgence. And I think perhaps part of the reason for this is some of the oversupply that has driven down margins in areas like solar manufacturing. We are starting to see some of those margins, and these are published EBIT margins. We're seeing them recover. So anyway, this is the history of clean energy. So I painted a little bit of a very strong growth and then a little bit of a fall off over the last 18 months, a slightly gloomier story, which kind of begs the question, what's our long-term view in terms of the future? And we're very, as analysts, we're very happy to call it as we see it. So we're not in the business of rose-tinted spectacles, but we do believe that the drivers are in place for continued growth into the future. And just as an example of that, if you look at solar, and this is looking at cumulative installations of solar going back as far as 1990, and that's the bottom curve. And you can see it looks roughly an exponential kind of shaped curve. It is an exponential curve. We took the log of it. So for any mathematicians amongst you, that's more or less a straight line. So it is literally exponential over the last 20 or more years. And that's really a rarity. People talk about exponential growth, but in fact, there are very few industries that grow exponentially over a sustained period. Probably semiconductors is one, mobile phones another, but you don't find very many of them. And solar to date is another. What's driving that? Oh, by the way, it accounts for roughly 2.5, 2.6% of total generation capacity. So in terms of the world energy mix, solar has, the potential to become much larger. So if you look at PV system prices around the world, then the bottom line is showing what's happened to total system costs for solar in China. So if you focus at the moment on the middle line, the green one, that's Germany. And you can see how big a difference. Well, first of all, you can see how much solar prices have fallen. And this is not just the solar panels, it's the total system cost. And then there's a lot of gap between Germany and some other markets. So this, if you like, is illustrating there's a huge potential if the rest of the world just caught up to best practices in Germany to reduce costs still further. So it's not just the solar panels, it's also the total system costs that needs to be addressed. And the costs are coming down dramatically. If you look at the modules, this is another log-log curve. And we do this, a lot of analysis like this is used for learning curve effects, where you want to look at the benefits of experience in terms of learning within an industry. And along the bottom, the horizontal axis, we've taken, again, cumulative installation volumes, and the vertical axis is cost. And one way of looking at this is every time you double the amount of cumulative volume in solar in the world, you get a cost reduction of about 24%. That's pretty aggressive, and it's pretty aggressive when your volumes are growing exponentially. So you've got this virtuous circle where costs come down. The effect of that is it makes the economics better. Volumes ramp up, you get more learning, and costs come down again. And that's the cycle we've seen with solar, and it's a very powerful cycle. The bottom curve, by the way, is thin film, which is another technology, a slightly lower learning effect to date, but it's at a lower price point to start with. So we don't see any reason why this shouldn't continue for some time in the future, but there's continued need to innovate around the other parts of the solar value chain. In terms of what this does to electricity prices and competitiveness, one way of looking at this is if you're a consumer and you're paying a retail electricity price, does it make sense to put solar on your roof or not? And the horizontal axis here is focused on insolation, which is essentially how sunny is it. So if you're in a country where it's very sunny, or on the vertical axis, the electricity price is high that you're competing with, then you're more likely to install solar. And the blue line, the curve, is the zone of indifference. So if you're above that, it would make sense to install solar because it's cheaper for you to do that than pay the retail electricity price. Now, we're making all sorts of slightly simplifying assumptions here, but it's an illustration of the cost competitiveness of solar. That's the situation in 2013 today. And by the way, this doesn't include any subsidies, so this is without any policy support. That's all stripped out. So today there are some countries, but not a huge number of countries, where solar can stand on its own 2 feet and be cost competitive. But if you fast forward to 2015, 2020, 2025, you can see more and more countries enter that zone. So this learning curve effect is very powerful and is fundamentally driving cost competitiveness within this part of the clean energy sector. We see similar effects for wind. The learning curve effect there for every doubling of volume is roughly 14%. So it's a less aggressive rate of decline, but it's significant nonetheless. That's for onshore wind. One other way you can look at this, and this is another kind of learning curve example, and there's been a lot of talk in the previous sessions about vehicles and electric vehicles and charging, which we track as well and find very interesting, is a big part of the cost today is the battery. So how far could battery costs come down? So here we've taken learning curve effects that you see in other battery technologies, for example, consumer lithium-ion battery. I have applied that to traction batteries for vehicles and looked at forecasts of what the demand for electric vehicles could be between now and 2030. And on that basis, the learning curve effect could get you to roughly a fifth of today's prices in terms of the battery. That's pretty powerful when the battery is by far the biggest barrier. Interestingly, the little red crosses are our index which we track based on manufacturer data that they supply to us on a confidential basis. The price of batteries, and you can see it's actually below the learning curve at the moment. So, that's probably due to oversupply within the industry because volumes haven't ramped up at quite the pace that manufacturers expected. But nonetheless, it's corroboration that you're getting a very powerful reduction in costs taking place. One other area that we think is very interesting, and I think there are going to be some speakers in just a minute, is what's going on in terms of buildings and management and also in lighting and control systems within buildings. And this is looking at some of the cumulative VC and P investment in lighting control companies. And you can see there have already been a couple of exits there and substantial amounts invested. So LEDs is another area where there's a huge amount of potential to save energy and actually quite a lot of activity in terms of installations around the world. To take one example of that, in China, the total LED market has reached just under $8 billion. Now, quite a bit of that is outdoor. It's replacing street lighting as opposed to indoor, although the indoor portion of that is starting to ramp up. But you're seeing very aggressive programs, both in China and actually in Japan as well, of LED rollout, and that creates, in turn, a demand for control systems to manage and make sense of all of that. So finally, I've talked a little bit about the overall patterns of investment. Just wanted to give you some color about some exits, and there are many more than these, but just some examples that we've seen as we look at different subsectors. So many of these you will obviously know. In transport, everyone's heard about Tesla, but there have been a couple of others focused on wireless charging technology and fast charging stations, so there have been exits there. In digital energy, which is kind of our label for smart grid, there've certainly been some exits. Silver Spring Networks is essentially a communications network for smart meters and ancillary equipment on the grid. But we're also seeing areas on how to manage smart meters, using software to manage smart meters, and also residential and load management and grid management. I think as the networks get more complex, and actually renewable energy is driving complexity in the networks because it's intermittent and because it's more distributed, so it makes the networks more complex to manage. There's going to be plenty of potential for innovative software and other solutions to help with that and make those networks more flexible. And then in energy storage, we've seen a few areas. Energy storage is very interesting, actually, simply because if you think about the economics of solar, to date we focus more on could solar or where will solar be cost competitive with other forms of clean energy. Perhaps a more interesting question is just how far can solar become competitive? Could it become twice as competitive as other sources of energy? Which, if you believe that learning curve effect, is certainly feasible. Now, that would create an enormous hunt for a viable storage mechanism that could counterbalance the intermittency of solar. Today, storage doesn't really work. It's not well, it does work, but it's not cost competitive for that particular application. But if you take some of the learning curve effects that I was talking about in electric vehicles and start to apply them, for example, to other markets such as storage for the grid, then further out, we might find some innovative solutions there. And we are already seeing that, by the way, in developing markets where a combination of renewables and storage, what you're competing with is off-grid diesel, and that's very expensive. So you've already got viable solutions there. And then finally, in energy efficiency, I've already mentioned a couple of these examples, but we're certainly seeing exits around building management, lighting management, and so on. So that's what I wanted to cover. I'd be very happy, if I'm allowed, to take any questions.
It's probably a bit unfair. It's a little bit directed at you. Jan and the whole industry. Bloomberg New Energy Finance is very positive on PV. The historical evidence would support that. Any PV companies at this event? And I don't mean like classical module vendors, because we all know that story, but there's clearly a lot of innovation still going on. Why aren't investors interested? Therefore, the companies are not here, or they're not funded, or don't think they can be funded. And what's going on in the PV startup world, you know?
We have one PV inverter company from Sweden tomorrow, OptiString. Quite early stage, but we will learn more. What do you think?
I think two things, actually. Well, quite a few of the companies we've seen aren't in Europe, they're in the US. And they tend to be in two areas. One is looking for other types of solar technology that could be more efficient and maybe work in niche or other applications. So if you've got limited roof space, for example, you might be interested in a higher efficiency application, even if it were more expensive, because your constraint is roof space. And we also see quite a lot of innovation in terms of downstream activity in solar, in terms of monitoring, managing, getting the best value out of your solar panels, and inverters would be another. Actually, inverters is another example where you can have a more distributed technology, where you don't have a central inverter, you distribute the inverters. So there's innovation there. But I think it's a very fertile area to look at, simply because to drive all those costs down, it's not going to just be the modules that will do it. You need innovation around the rest of the value chain within solar.
Okay. David? Yeah?
As we see on your slide, the investment of large renewable infrastructure are increasing and increasing every day. But that's clear that the venture capital investment have largely decreased. Do you think that we could go to a new rebound of venture capital investment, or the sector is definitively in a deep difficulty? I would say, shall we see a new wave of technological investment, or most of the money will go for the rest of the time to the large infrastructure in the renewable sector?
Yeah, I mean, it's hard. It really is hard to predict that, and you should probably ask some VCs in the audience. But I would say that the VC element in terms of those numbers has always been a relatively small proportion. So actually, we haven't seen VC investment fall off. And indeed, in some areas, sectors where you might think VC was more mature, like solar, for example, we're still seeing VC money flow into that subsector. So when you think about the innovation that needs to take place in the energy system to cope with intermittent supplies, to cope with much more complex grids, to cope with more distribution, I think a lot of innovation is needed there. So whether that then results in a flow of VC money is harder to predict, but I'm convinced you need innovative solutions to drive that, and early stage companies will have to be part of that.
Wonderful. Thank you very much, Michael. Here's your speaker gift. Welcome.
Thank you very much.
Thank you very much.
Okay.